This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. My name is Alex Perny, and today we're with, Bigger Garage Capital, and we're going to be covering a market segment of commercial real estate, which I find very interesting. Most people are kind of used to the general talk of commercial real estate syndications, the big buzzwords that are out there, and they think apartment buildings or commercial real estate, but that's where most people gravitate towards. And more we're hearing things of people talking about market segments like self-storage facilities. And self-storage facilities is going to be the one that we're going to focus on today. I find it a very interesting market segment because one, you don't have to deal with tenants and toilets, you're just dealing with people's stuff. So the management of these things is a little bit different. And I'm sure we all notice, especially if you live in any type of metropolitan area, that these things are going up at a pretty ready clip. Not so much here where I live in St. Pete, Florida, but it's certainly there is a need for them in a lot of places as people downsize, they move, they typically don't sell all their stuff, so they have to have this place to store it. So Paul, thank you very much for being on with us today. Maybe give us a little bit of background about yourself, kind of how you came to be in the position of co-founding this company that focuses with a strong focus on self-storage, and we'll kind of go from there.
Yep. So I'm a trained engineer by trade, and I started thinking that I needed an alternate source of income. And so I got started in real estate investing probably 2008, or no, it's 2018. And I grew a residential real estate portfolio to about 25 doors, rental houses, a couple duplexes, one quad in the Indianapolis market. And then, as we all know, there was a pandemic, which really shut a lot of things down from a real estate perspective, at least in my area. And I got a little concerned about being able to enforce my lease with the eviction moratorium. And so I wanted to diversify my real estate investment into an area that didn't have that. So about that time, 2020, 2021, I met my partner, Mike Margarella, and we started, he was just getting into residential real estate as well in Indianapolis. And so he and I talked a lot about, what kind of alternative real estate investments are there that we could get into. And self-storage at that time, it was getting pretty big. We may have gotten a little bit late to the party, but we partnered together and started looking to acquire self-storage. So that's how we got started, and a little bit of the background.
Okay, so the initial foray into it, again, a lot of people kind of can probably resonate with that. When it comes to any real estate, it's like you start with the single family, okay, great, and then you try to get another one. You're like, all right, well, maybe if I put the same amount of effort, I can get 2 doors in a duplex or 4 doors in a quadplex.
Yep.
But it's kind of a tale as old as time, saying, hey, how can I increase my throughput with this? For the same amount of effort, how can I make more money at something? And I think, no matter if you're in real estate, sales, or if you are, again, just, an engineer, as you were as well. It's like, how can I kind of, increase, the profitability of my time being my most valuable asset? So you kind of identify the self-storage space as something that you like. And again, especially I think with COVID-19, it kind of paints it painted a very grim picture, but it also illuminated a lot of things for people. And that's something that I think is interesting, is that, it wasn't so much of a, profitability standpoint for you, but it was saying, hey, there's some real risk. So it was more of a risk mitigation play to get into self-storage, which I find interesting. So you're at the point, you say, okay, let's start, acquiring self-storage. Was there a particular reason? Was it maybe the amount of capital you had, or was it just maybe a less barrier to entry to start doing the acquisition side instead of a development play on this?
Yeah, so I mean, honestly, we were wanting to follow that tale as old as time, like you said, is you start with the rental houses, and then you move to duplexes and quads, and then you move into apartment buildings. And we've got, my partner Mike and I, we have several real estate friends that did just that. And they moved right into apartment buildings, and they've got a lot of them, right? And so The whole reason why you get into apartment buildings is economies of scale. Now you've got a whole bunch of people all in one area, and you can manage it from geographically, the location, et cetera. The financing of a single property, it's commercial financing, so it's a lot easier to do. The appraisals are a lot better. So there's just a lot of nice things, economies of scale wise, of like apartment buildings. The problem was if we were getting a little bit late to the party for self-storage, we were the party was almost over for multifamilies, right? I mean, the cap rates that they were trading at were like unbelievable. And we couldn't make anything work. And on top of that, I think you mentioned earlier, toilets and even electricity, and then people living in these units, and some of the restrictions around leases. They're often 12-month leases, and then there's an eviction process. And so we were looking for how can we do the economies of scale, but take out some of the pieces that are problematic for that type of asset class. And that's where self-storage is. It's essentially a multifamily, but without the people and without the restrictive leases.
Okay, so I think those are kind of, again, easy things for people to grasp. But one thing that I kind of think about with this is that, real estate has one common thread no matter what you look at, unless you're, buying swampland in insert X part of the South where I live, is that it's all expensive. It's got a big dollar figure. There's typically a couple commas, maybe even, three or, a little bit more if you start getting expensive quick. Now, with something being expensive, that's all well and good, but you have to invest and be able to make revenues off of that. So let's maybe take a look at that. You mentioned, apartment complexes having all of these different types of issues, but one, big thing they do have is that, you can charge, a good amount of rent typically for per door. The utilization of that space can, probably dollar for dollar on the square footage yield you more revenue. Granted that curve also goes with a correlation of expenses as well. You don't have a toilet in a self-storage facility. You don't need to have a kitchen with, relatively updated appliances, things like that. Someone's old couch doesn't, complain about the, water being, turned off.
Right.
So I would imagine that looking at it from that perspective, that the revenue differential is probably pretty good. So you're looking at that delta between revenue and expense being pretty good. So what kind of pricing difference are you seeing between, let's say, and I don't even know how you'd necessarily compare the two, but as analogous as you can, like how does the comparison work for initial, cost basis versus revenue between these two assets?
Yeah. So hopefully we don't get any haters out there on multifamily. But self-storage, the my understanding of multifamily, the expense ratio, gross rents versus what you can expect in expenses. My understanding is about 50% expense ratio on apartment buildings, right? Whereas when we underwriting self-storage, in many cases, we can do a 30 to 40% expense ratio. So the expenses on average are lower on self-storage than on an apartment building. And so, that is, obviously there's no toilets, there's very little electricity, those things makes a lot of sense. And then the management is a lot different, right? Because we don't have to have a 24/7, emergency maintenance team, and a lot less can go wrong in self-storage. And so maintaining them are just a lot more affordable. I'd say a majority of our expenses goes to trying to find tenants from a marketing perspective, whereas apartment buildings, it's a very different cost profile.
Okay, so you're saying, in general, your cost delta is somewhere in the neighborhood of maybe 20 to 15% between what your gross revenues are and the expense ratio of the property, which I find to be pretty attractive. If you can say, hey, taking two commercial assets and saying, hey, this one, on your basically looking at your net, you get a 20 to 15% bump in a positive direction just by saying, hey, going X versus Y. Again, I find that attractive, but looking at it in the context of saying, okay, great, well, if these both cost the same amount to acquire, then is that really necessarily going to be a good thing? So at least on, I think it's good to kind of start at the beginning of everything and kind of work our way to the end. So the first thing you got to do to be invested in real estate is acquire some, right? So you mentioned that was kind of your thought process is saying, hey, we initially wanted to do commercial multifamily. COVID hits, you start seeing, basically you put glow in the dark powder on every single one of those cracks that's in the that type of investment strategy, and you start seeing, hey, where does this lie? So on the acquisition side, again, I don't even know how you necessarily compare the two because the utilization is totally different. But in a broad sense, what are we looking at as far as cost differentials between comparable assets in these two classes?
Yeah, I'm not sure. I know that the cap rates, when you look at commercial property and the NOI on an annual basis for multifamily versus the NOI on an annual basis for self storage, there's going to be different NOI. But if you level set that from just the NOI perspective, very typically, we'll see self storage trading at like 6, 7, 8 caps, whereas I've seen apartment buildings trading at 3, 4, and 5 caps. So in general, let's just say NOI for NOI, the apartment buildings are trading at a higher cost, per dollar that it profits, if that makes sense.
No, it definitely does, and it would make sense for that because your net revenues or your gross revenues are just going to be higher. You can charge $2,500 a month for an apartment as opposed to a self storage. I mean, maybe somewhere you can, but I certainly haven't heard about it in my career.
Yeah.
Okay, so again, I think looking at that and saying and looking at the cap rate, I think is probably going to be the most like telling sign of this. Saying, hey, look, all else remaining equal, we're looking at exactly what these things produce. Cap rate is going to kind of be what gives you the best marker of saying, hey, here's what it's kind of generating on that
Hmm.
scale. So again, we've kind of covered the acquisition. Now, looking at the actual asset itself, again, I think it's relatively self-explanatory. Not to make too much of a pun with self-storage, but the utilization of it's pretty defined. You have people that come in, they want to store stuff, and I can't imagine there's really much that goes into it as far as the building, the maintenance, and everything else goes. But what are some of the kind of things that you look at when kind of addressing the asset? So you say, okay, this makes sense, but what else goes into saying, hey, this would be a good one to acquire?
Yeah, so our focus is on trying to acquire mismanaged facilities. So even if we buy it at a 7 cap or a 6 cap, our thought process is we can add additional revenue and thereby additional NOI, and we can increase the value of this property. Some of your listeners may be familiar with the BRRRR process, right? So like a residential property, you buy it, for well below market price. You come in, you put new flooring, you put a new kitchen, new bath in, and now it appraises for a lot more money. And then you could go to a bank and you can do a cash out refi. And the idea is that if you bought it on short term debt, now you can refinance it into long term debt and maybe take a little bit of money out of it, and maybe not have hardly any of your own money invested in it, right? So now you apply that to self storage. If we're finding facilities, we're looking for facilities that are mom and pop operated, but typically mom and pop operated, they've not implemented all of the technology that's available to automate the process and to run the facility not just with the minimum expenses, but also at the highest revenue possible for that property. So what we're really looking for is, if we come across a property, what are the value adds that we can do to that property to increase the value of the property, to increase occupancy, to increase rates, or are there additional revenue avenues that that property has? A good example of that, we bought a self storage facility, Muncie, Indiana, home of Ball State, where the previous owner, they sold it at, I don't know, 7 cap, 8 cap, but it had an empty office building on the property. And they used that empty office building for, their part-time manager to just hang out in. Well, we're going to rent that guy out, and we're going to rent it out for $2,000 a month. So that increases the revenue, and really doesn't increase the expenses all that much, right? In fact, it may lower our expenses if we're able to get a majority of the utilities and stuff paid for by the tenant. So those are the kinds of things that we're looking for. We're looking for not just mismanaged, but mismanaged is good. We're looking for value add opportunities where we can increase the NOI, and if it's trading apples for apples cap rate in 3 to 5 years, then the price that we can turn around and either refinance it or sell it is much higher because we've increased that NOI.
Okay, so would you say that most of the time the play in this space, at least from your perspective, is, value add reposition sale, or are you trying to build a portfolio of operations, or is it kind of just a mixed bag, whatever one looks good and, kind of fits that avatar, investment portfolio criteria is what you kind of pick out?
Yeah, I mean, I think different self-storage investors are different, have different angles. We're definitely the value add group. That being said, you do have to have kind of uh, a sizable portfolio in order to make the operations profitable. Meaning that we have one office manager here in the United States. She works remotely, but she manages all of our operations. Well, when we had two facilities, it was just her. She did almost everything, and it was tough to pay her salary, and then also for her to cover the amount of work that needed to be done. But as we've grown, now she doesn't take any calls. We have a call center offshore, and she's able to focus more on value add capex type of activities, because we have a larger portfolio. There's economies of scale, and so from that perspective, I mean, it does help acquiring facilities that allows you to benefit from the economies of scale.
Okay, great. And I think we kind of missed a chunk. I think that's really good information on, the strategy that again that you generally have is more in the, reposition, finding some type of, particular issue, distressment that would, lend itself towards this strategy. But, it's easy for people, I think, to kind of think of, hey, what's going wrong with an apartment building? Okay, well, is there bad lighting, no assigned parking. There's a lot of different things that's easy to pick out. Like stick a
Hmm.
pool in, you can charge more for the rent,
Yeah,
but you're not sticking a pool into a self storage facility. So, when it comes to people kind of saying, hey, this is an interesting market for me, you mentioned a few mismanagement, the office building that was there that wasn't being utilized, but I would say that's probably the exception, not the norm. You don't acquire these things and they have, four spots to have some retail just stuck right in. So,
right.
in general, what are some of the kind of, key factors that pop up the most, and, how do you kind of go about remedying them when it
Yeah.
comes to reposition factors for these types of properties?
Yeah, absolutely. So, like, just looking at self storage all by itself, I mean, I will say, uh, parking is a good example of something that, a lot of these facilities that are out there, they've got some amount of land, and they've put some number of buildings on there, and maybe the long-term plan for the original owner was that they would continue to build buildings, and they just maybe their occupancy wasn't where it needed to be, so it didn't make sense to build more buildings. But, we've added parking, and all you need is gravel, and you can have vehicles parked out there for 50, $100 per spot. So that's an opportunity right there just to add revenue to a standard storage facility that maybe, you wouldn't have thought of. And almost all of our facilities have some level of parking, because it just adds a little extra revenue to a property that might have not otherwise had it. Along those same lines, there's additional revenue opportunities. We require all of our tenants to carry insurance, and we tell our tenants, you don't have to buy our insurance, but you have to carry some amount of insurance. Um, Many of our tenants, probably 70% take rate on our insurance. And so there's a revenue split on, their premiums. So they pay $12 and we get, 60% of that. And so, multiply that across a facility of 100 and some odd tenants. now you're looking at, an additional three or four, larger units that you don't have to build. So there's additional revenue there that you can add to the property that maybe a mom and pop didn't mess with. And one of the things we really like about that is that um, that's protecting the tenants as well. So, unfortunately, one of the difficulties of managing self-storage is security. And the would-be thieves are getting smarter and trickier on how to get in them. And so we're constantly having to find ways to protect our tenants. And that, it's a win-win for our tenants and for us offering that insurance. Another revenue area that we implement is along the lines of security. We overlock all of our doors. So we use a system called DaVinci. They sell these locks with serial numbers on them, and we put blue locks on all of our vacant units. So when a tenant goes and rents a unit from us, that vacant unit is going to have a lock on it already, and our system will automatically text them the lock unlock code. And we tell them, hey, if you would like to rent that lock, you're welcome to do it. It's $2.50. So, I don't know that that's a huge profit center, but what it does is it does increase the security of our facility. Those locks are very difficult for anyone to cut off or break. And so, that reduces any, insurance claims that we might get. And it covers any vacant empty units. We're able to lock those essentially for free. That's another issue in self storage is, people go out there, they've rented unit 5, and they get to it and they've got more stuff than what will fit in there. Rather than calling us and say, hey, I need another unit, we've seen a lot of cases where they'll just open up a vacant unit adjacent to it and throw some stuff in there. So that's, helps us with security and, selling more units if people run out of space.
Okay, that's really interesting. I'm familiar with the Da Vinci system from real estate. They make one called the Super, which is like the blue lock box you see on all the
Mhm.
rental properties around here, where they just go
Yep.
tap it, drops the key out, you can walk into the door. So that's not something I would have necessarily thought about of the automation of the locking of the units themselves. I would think that the automation would come a lot more on the workflow of actually just getting rentals done. Someone logs on, they see the availability, they pick it, say, hey, I want this one, sign the contract, you get the gate code, you go and drop your stuff. But that's probably, again, I'm sure that's part of it, right? That's not
Yeah.
something a lot of mom and pop places have. So that would probably be something that is easy to put in. And are those kind of systems something that are relatively easy to just kind of copy paste to new properties, or do you have to do kind of a new build out of systems for each new one?
No, that's what's really nice is, once we had our operations team and our operations systems, like a tech stack, put together, our vendors, how we operate, it's really a rinse and repeat, right? And there is a little bit of setup to get the systems plugged into a new facility, but it's a lot easier to do to repeat, right? So that's exactly what we did. We have our camera vendor. Every single facility, we use the same camera vendor. So when we want to monitor cameras in all of our different facilities, it's one login, it's one interface, and then we use the same gate system. So at every facility, it works the same way. And to your point, exactly, one of the ways that we can increase our occupancy and increase, lead conversion, meaning that people express interest in storing in our facility and then getting them to move in and pay for a unit, is how difficult is it for them to do that, right? So having a great website, having it automated where, like, in the middle of the night, if they want to rent a unit, they can go to our website, they can rent a unit, the system automatically sends them all of their information, they can sign their lease electronically through the e-signature. So it's very, very easy. We try to make it frictionless for tenants to be able to find our facility through our marketing efforts and then move in to one of our units, pay online, and in some cases, our operations team don't end up even having to speak to them. They're able to
Nice.
completely move in themselves.
Yeah, and I haven't had a storage unit in like 10 or 12 years, but that was one of the things that I personally looked for was the ability to like not have to talk to someone. I think
Yep.
even back in like 2013 when I had one, it was the only thing I had to do was it was all indoor stuff, so they had to like I don't know, give me something or I don't know. But it was very easy. That's why I chose them. I was like, look, I can have as few people as I got to talk to. It's like because at the end of the day, again, it's not an apartment. It's like it's a box to throw stuff in.
Yep.
that I don't want in my
Yep.
house. So, I think people have kind of wised up to it. So much of, I think life, especially nowadays, people like, well, I'd like a little bit more of a human touch to things. But I think this is one of those areas where, you can probably get away with it to so long as it's polished, right? You can get
Yeah.
away with having less human interaction. People probably actually gravitate towards that.
Yep.
So, again, I think what you're talking about as far as the value add to these places, makes a lot of sense. If you have parking, hey, not a lot of people can put their boat behind their house. Or if you have an extra car, I'm the guilty party on that one where, I only have so much garage space to store my wonderful investments that I call old Jeeps and motorcycles and stuff. So, I only have so much stuff for that. So, kind of, getting more blood from the stone in a sense for that.
Hmm.
But like you mentioned, I think one of the big things that you're up against is occupancy for these things. It's with any type of property, how do you make cash flow with it? It's tenants and revenue. So, you come into some place, you see these things, okay, we can automate, gates, locks, security, cameras, e-sign and everything. But, if it's not renting, that's definitely a problem. So, when you come in and that's identified as maybe an occupancy issue with a place, what are some of the concerted efforts that you make to help drive that? And I'm sure it's probably a summation of, a lot of the things that you said, but, what are some of the kind of things that you do? And also, what are some of the hurdles that you have to cross to get across that finish line to, have the ideal 100% occupancy for these things?
Yeah. So, when we see a low occupancy facility, let's say, we've been approached to do third party management, right? So we're looking at a property that's been operating with third party management, another management company, and we're trying to understand why is this facility not performing in the area that they're in. Um, Almost always, it's a couple of things. One, they're not answering the phone, and no matter how many people there are out there um, that want to do the frictionless, self move in, there's any number of people that are wanting to have that personal touch and want to talk to a person. And I would say 60% of our tenants insist on talking to a real person. And in today's day and age, call your utility company, call, any other, operation. Very rarely you can't get a hold of a real person. So our priority has been, and the reason why we built our operations the way that we've built it is to profitably, and reasonably answer the phone as often as possible. Um, and so that is our priority. But in addition to that, if the phone's not ringing or you're not getting enough leads, there's an issue with marketing. And marketing is a huge cost to operating a self storage facility or a suite of self storage facilities, especially as the large kind of Wall Street REITs are moving in and buying up a lot of these facilities. It's squeezing folks like me and smaller operators, even in the tertiary markets, because they're throwing hundreds of thousands of dollars at marketing every year. And so you just get drowned out in the digital marketing space if you're not actively investing in that. So we've retained a marketing firm that is specialized in search engine optimization, Google Ads, website presence, and really even brand recognition. So Bigger Garage Self Storage is our brand, and it's we don't have a lot of states, but we're a nationwide brand as we grow our portfolio nationwide. And so that recognition, that search engine optimization to drive traffic to our website, to our geographic locations, that is a major source of, it's a major determinant of what your occupancy will eventually be. And then the final piece is rates, right? Especially if you're in a market that's very competitive with some of those large Wall Street REITs. The way that they operate is they'll drop their prices down to almost nothing. I mean, I have seen cases where they're selling the small 5 by 10 units for $15. You know, but what they'll do, the strategy, and it's a strategy that we follow similarly, is they'll drop rates down very low during lease up. And as they approach that 70 or 80% occupancy, they'll raise their rates for incoming people, and then they'll start raising the rates on those people that got in very, very low. And as those people at the low rates get mad and move on to the next, discounted rate, they start filling them in at a slower pace with higher rates. So kind of the yield management of raising rates and a lease up strategy at lower rates. It's all part of competing with the Wall Street, the big guys, and having enough search engine optimization and traffic so that people know where you're at.
Yeah, for sure. And that was kind of one of the things that I really wanted to glean out of this was I was kind of, a little confused on how, that works because I've always seen that. And I'm sure most people have too. If you've ever looked for a storage unit, it'll be like 90 cents for the first, it's some arbitrary cheap number and you're like, "Ooh, wow, yeah." And of course, like with anything, it's going to go up.
Yeah.
It's I think people would be a little bit foolish to think that that's a sustainable business model. 100 units at 15 cents a pop, that's not what's happening.
Right.
It's they got to they actually have to keep the lights on. I guarantee you the power bill is not covered by that. So,
Right.
from that perspective, yeah, that definitely makes sense and kind of was in line with what I thought. But you never know until you ask. Now, the other thing, especially with real estate, we talk about getting these things leased up, but you have to keep the tenants in there. One of the biggest problems for any type of real estate, whether it's again the single family, the duplex, triplex, commercial real estate, is tenant occupancy and turnover. So, what kind of turnover rates do you see with these things? I'd imagine, for a large majority, and I always give my parents a little bit of grief. I'm 35 and they've had a storage unit for as long as I've known them, and they're just now getting rid of it. Like there's stuff in there that they put in when they moved to Florida that I guarantee you they haven't touched in 35 years, but again, they keep it. So, is there a lot of turnover? I'd imagine there's not, but also kind of, one, how do you kind of, is turnover basically just put back into that, cycle of, re-rent in your marketing efforts? And then also, essentially for stuff like that, I would also imagine people just kind of abandon these things. So how do you handle, quote, an eviction process or whatever the most analogous, situation is for this type of asset class?
Yeah. So for turnover, I wish I had better statistics on this. We have people that have been with us for 14 years, 15 years. And some of our tenants don't even live in the state where their stuff is stored. Like we've got a lot of people out of state that they stored it and then moved away and then just haven't come in back. So there are those those are, and we just keep on raising rates on them and they keep on paying them, right? And then there's really another group that are a little bit more responsible with it. I would say is at least financially responsible with it, where they'll use it for like a short-term move. Maybe they're moving from one apartment to another, or from an apartment into a home or a home into an apartment. They'll rent it for a couple weeks to a couple months, and then the only other move-ins or move-outs is some of those long-term people that get tired of the rent raises, right? Which is just a natural part of our business. So I would say that, let's say 40% of our tenants are just long-term; they're not going anywhere. And then maybe another 20% are the folks that are, kind of a medium term, but as the rates go up, they're going to vacate. And then, maybe another 20 or 30% are the, let's say, transitory, where they're capitalizing on those low rates. They're moving in. They don't plan on being there long term, and then they responsibly move out when they don't need it anymore. And So that kind of gives you an idea from uh, across our portfolio, people moving in and out. Um, the Which again is why marketing is a constant, right? That doesn't ever go away. You're constantly trying to need to find new tenants. And as we raise rates, our expectation is that our occupancy will be between 80 and 90%. Like we don't ever want to be 100% occupied. If we're 100% occupied, our rates are too low. So that we manage it, rate increases based off trying to keep it in that sweet spot. Um, and then, there are people that quit paying. And so every state has their own lien laws. Some states are more strict than others. But in general, across the nation, the way it works is we're required to provide notice of some kind. Sometimes it's mailed, sometimes it can be via email, that the tenants are delinquent. There's usually a time frame between 10 days and 30 days when we could overlock their unit. There's a time frame, usually 24 hours to 10 days when we can actually lock them out of the gate. So believe it or not, locking them out of the gate and denying access to the property, usually we can do that more quickly than we can actually put a lock on their unit. Um, and then once the lock goes on their unit, it's between 60 and 90 days that we can actually auction the unit. And so this is another area where we've automated. So we do have some boots on the ground at each facility. And as those auctions come up, whether they're 60 or 90 days, we'll cut locks, we'll open the unit, we'll photograph it. Those will get uploaded into an online auctioning system, and then it just goes from there in an automated fashion. So our management software recognizes that there's auctions that need to be done. Our office manager moves them into whatever auction scheduled that needs to be done. It links to the online auction system. Our boots on the ground upload the pictures, and then it runs. And then the next time that we really have to be involved in the auctions is when the auction winners call and they're needing access to the gate and access to the overlocks. And so, we do everything we can to avoid auctioning. It's a necessary evil of the business. We don't like auctioning anybody's stuff. So very typically, if a tenant is engaged with us, we'll give them every opportunity to avoid auction. My team offers payment plans where they can pay a fixed amount on a weekly basis until they're caught up. That's not required by law, but it's something that we feel like it's the alternative to people losing their stuff. So, but we try to automate that as much as possible.
Yeah, and from those perspectives, I mean, is that I would imagine, again, using my parents as an example, is that a rarity or is it, relatively common? Do you see it ebb and flow with the market? I mean, how often does it kind of come to the critical junction of having to auction something out? Is it, again, rare or is it just kind
Yeah,
of sporadic or
I
common?
will say that, out of a facility of, let's say, 150 units, we probably auction 5 units a month.
Okay.
So that kind
Yes.
of gives you, yeah.
I'd say that's, not too bad. I mean, ideally it's probably one of those things where it's probably almost kind of a net wash with the, human capital that you got to put into doing that. It's not going to be a revenue center for you to do it. And, it wouldn't be a very
No, and
good revenue center even if it was.
yeah, and ultimately, I mean, all state laws, to my knowledge, you're not allowed for it to be a revenue center. So you can only recoup uh, what you're short. Meaning,
Oh,
we do everything we can to justify uh, fees. So late fees, we have documentation fees to mail out the notices. We have overlock fees because boots on the ground have to go out there and overlock them. And then when we do an auction, we have to cut locks and open the door and take pictures, and we charge them for that. And so, we try to build up enough fees so we don't make any money off of the auctions. Any
yeah.
additional that we make over the auctions, legally we have to return that back to the tenant. And that's
Okay.
just a whole nother, effort that we don't want to take on. So Rarely, very, very rarely do we make from the auctions more than what we're owed.
Yeah.
Um,
Yeah, it makes sense. And before we get into the next part, which I think is kind of a good way to kind of clean this up, is of the from the outside investor perspective. I think we pretty well covered the the viability and the different things that go into this. One thing that you mentioned I thought was really interesting that I wouldn't have necessarily thought is that again you don't want to be at 100% occupancy, so you're almost treating these things more as like a retail asset to where if you had 100% occupancy, I'd equate that to having no inventory to sell.
yeah,
Just because if
exactly.
you sell out of something, that's great, but then you have no way to make any more money, you have nothing else to sell. I think that's really pretty interesting. And what would you say is kind of your ideal float for availability? Is it 10, 5%? What's kind of that magic number to where if you're writing at this amount of vacancy, it's kind of the ideal area for you to be.
Yeah, like I said, I mean, we usually try to bounce between 80 and 90%. If we can be 80% through the winter months, we're really in good shape. And then we'll usually see a bump in the spring. Like right now, we're seeing a lot of move-ins, a couple move-outs, but a lot of move-ins. People are, getting ready to go. The warm weather. I know down in Florida, it's been nice all summer long, all winter long. But here in the Midwest, it's very similar. It follows the same path as kind of the spring bump for home sales, right? So you look usually in the winter, even in Florida, things slow down through the winter, the holidays and such, and then as it starts to warm up, February, March, April. I lived in Michigan for a long while, so even May, it's finally warming up. Um, During those periods of times, people start moving around. So they're, looking for new apartments, they're, buying new homes, etc. And so all of that activity, we see a big bump. And so during that period of time, our goal is to try to not exceed 90%, meaning that if we go past 90%, we were too cheap, right? And so if we can bounce between those two, that means that we're maximizing for that 80 to 90% occupancy window. The units that are rented at the highest market rates that we think we could command. And then we sell units very similar to the way an airline sells seats. So the very last 10 by 10 in our on our facility is the most expensive 10 by 10 that is sold. And so uh, our system is set up as the occupancy for that particular unit gets higher and higher, so does the price.
Okay, cool.
So that gives you, yeah, a little bit of it.
Okay, cool. So, all this is, all well and good, but, everyone, wants to, kind of get a piece of the pie. So, you do all this stuff to, again, create value for shareholders and your investors. So,
Mhm.
when it comes to, the investment side of things, what are some of the things that kind of, play into, an investor side of these things? Do you typically do these things as one-off syndications like a lot of these commercial real estate developers do? Do you kind of package them in as kind of a revolving fund? Is it a mixture of both? From an outside investor perspective, kind of what are they actually pursuing if they were to pursue something with you?
Yeah, so we've done it all. So we've done small joint ventures with a small number of investors, usually people that we know very well, that are more involved intimately in the business. And we've also formed a fund. So we just actually concluded our raise on a $2.5 million fund. And so going forward, we'll probably continue to do some syndications and funds. It really depends on the size of facilities, right? So, uh, you know, if we look to acquire a $5 million facility, um, it's likely we'll just syndicate that single facility. Whereas, we might form a $5 million fund and put, $4 million facilities inside that fund, if that makes sense. Because there is a cost to setting up the legal structure to be able to offer those, because they're considered securities. So, the SEC is involved, and we have to retain attorneys to do that right. Um, from the profile of investors, uh, our focus typically is on cash flow investors. So whether they're looking for, regular cash flow in their retirement portfolio with self-directed IRAs, or they've got some cash on the sidelines and they're looking for tax-free cash flow or tax-deferred cash flow personally. So there are some operators out there that will do like large self-storage developments, and those developments don't cash flow for like 2 years because have to go through lease up, you have to go through the build and permitting and all that stuff. And so that's really not been our profile. We try to focus on acquiring a facility that is cash flowing today, and then our goal is to just grow that cash flow. So very often, our profile from like returns perspective, um, we offer, let's say, I think it's 6% um, preferred return, meaning that we pay out 6% before the sponsors get anything, and then anything beyond 6%, usually we expect a closer to 8% before the refinance. Um, it's a 75-25 split or uh, yeah, I think it's 75-25 split. Or yeah. And then after refi, we usually are looking at between 10 and 12%. So
Okay.
refinance, what we'll do is obviously we've increased the value of the property. We're able to go and refinance it at a higher valuation, and then we do a return of capital, and then you'll receive 10 to 12% higher return on the remaining capital in the investment.
Okay,
Uh,
great. So it's not too terribly outside the realm of, I hate to say normal when it comes to real estate because everything's so different.
yeah,
But it's an investment. It pays some type of pref. There's return on capital at a liquidation or a refi event. The important thing here I think is understanding kind of the inherent nature of the investments themselves and what goes into this. The other question which I kind of got lost in the sauce a little bit of what we were talking about, but the one thing I really did want to kind of touch on is the difference in the tax perspective, or I should say the write-offs and losses and things that go into this. Because when looking at apartment buildings, it's easy to say, okay, if we're going to do a cost seg or a cost segregation analysis on everything, it's a lot. There's a lot more items to pick apart. If you have
yeah.
individual AC units, if you have
Hmm.
toilets, countertops, appliances, with the exception of, rolling garage doors and maybe if you have climate controlled stuff, is it still as tax advantageous for the most part? And is that kind of a direct correlation between just the fact that these things are cheaper than apartment buildings? So the amount of cost seg and depreciation you get, or is there some, big awesome thing that, maybe I don't know about when it comes to the depreciation scales for these types of assets?
Yeah, so I mean, you're absolutely right. A cost seg on an apartment building, square footage or whatever, it's going to be more expensive than the cost seg on a self storage facility because there's just a lot of different pieces that have to be segregated. Self storage, like you said, there's just not a lot of materials there, right? It's either steel or wood, and it's got a asphalt or metal roof, or it's got roll up doors that are usually metal. So it's there's just not, and then concrete, and that's about it. Uh, and so it's a lot more affordable of a cost seg than what you'd see for an apartment building. And then a large majority of the materials can be uh, depreciated in the first year. So whereas I think the cost seg spreads things out a lot more. It's still a lot better depreciation schedule, but it spreads things a lot more because there's just a lot of different pieces. Like you said, air conditioners and stuff like that. There's a lot more to it on an apartment building. But either way, it is a substantial tax benefit, uh, very similar to what you'd see on a large multifamily. You buy a $2 million building, you can have, a substantial tax write-off on that. And for our investors, there, like I said, there's two different investors. One investor, it's going into their, tax deferred or tax deferred account, so they're not as concerned with that. But for our, cash investors, they're looking for that return. They're not going to have to pay tax on that, at least initially. So it is a very similar to apartment buildings from that perspective.
Okay, great. It's again, it's just something I always like to ask in these scenarios, and I'm assuming I'm probably pretty correct on the fact that yes, there's less stuff to depreciate, but the asset is also cheaper. So the amount of depreciation and what you actually glean from maybe a cost seg is going to be, if you were to run a ratio, similar to what you get on an apartment building. But again, the acquisition cost is going to be significantly less. So again, that spread is comparatively going to be similar, right? So again, thank you very much. So if people are listening in and they want to get in touch with you or maybe learn more about what you have going on, what's the best way to contact you?
Yeah, so the best way to get a hold of me is Paul, Paul, at biggergarage.capital. So we'd love to hear from you. Feel free to reach out. Even if you're not looking for, at least initially, at a passive investment, if you want to learn more about self-storage, if you have some self-storage facilities, you'd love some advice on how to increase occupancy or manage them more efficiently, we'd love to hear from you, share that knowledge. And then if you decide that you don't want to answer phones or build a call center to answer the phones for you, we'd love to welcome you as a passive investor as well.
Alrighty, Paul. Well, thank you so much for being on with us today. The most valuable asset we all have is our time, and I appreciate you taking some out of your day to speak with our listening audience. My name is Alex Perny. Again, this has been the Alternative Investing Advantage podcast. Thank you so much for joining with us today, and we'll see you on the next one.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.